Alrighty, we'll go ahead and kick this off. Good morning, everyone. This is Stephen Jenkins over at Insurance Agency Marketing Services. I want to thank you for joining us on the call today. We have an exciting topic, and one of the reasons for that is because IAMS likes to stay ahead of the curve on legal regulations when it comes to the industry. And not only that, but we also have some exciting news on Symetra's new product developments. But before getting into the main event, I did want to take a couple of minutes to chat about some additional ways IAMS is here to help add value to your business. First up, we've got our new producer builder, and as you can see there, we got a few different point totals from 100,000 to a million. And in your first 6 months with us, you can automatically get enrolled into our new producer bonus program. You can see there's a variety of different options up there that you could cash out, whether it's marketing programs, marketing dollars, cash trips, etc. If you got any questions on that and would like to know a bit more, just reach out to one of us sales directors here. The number is 800 255 5055. In addition to that, we got a referred producer program. If you know of an agent who maybe isn't quite happy with their current IMO relationship, or maybe you think they'd be a good fit over here, send them our way. Not only will you get a bonus on when they first get contracted, but on an ongoing basis, you'll receive a bonus based off their production. You don't have to do anything. We'll take care of all the service and support for that agent. Could be a great way to generate an additional revenue stream for you. And in addition to that, we got our standard marketing reimbursement program. As you can see, that's $100 for every qualifying 100K of an index annuity premium. And then on the life insurance side, it's $200 for every 100,000 of single premium life and $200 for every 10K of life target. Again, if you'd like to know more about that, just reach out to one of the sales directors here. That number is 800 255 5055. Back office support, I'll touch on this for a moment. It's been the cornerstone of IAMS for the last 38 years, whether that's pre-sale illustration design work or pre-underwriting, submission to commission process. Our team does an amazing job. So if you haven't tested us out yet, I'd encourage you to do so. We have our IAMS portal out there that is a wealth of resources. You don't even need to be contracted with us to access it. So if you're not, once again, I encourage you to reach out to sales directors here at 800 255 5055. We've got our quoting software out on the portal for annuities and life insurance. We've got our current rates. In addition to that, we've got our e-app platform, product information, underwriting information. We have our sales resource library, which has hundreds of point of sales pieces. Out there, you can instantly download just about any topic you can think about talking to a consumer about. If you have any questions, reach out to one of the sales directors, 800 255 5055. I do want to mention that our portal does integrate with all of the standard e-app platforms, so Firelight, iPipeline, as well as Sunfire on the Medicare side. If you're curious about what carriers integrate, we do have some cheat sheets out there, so reach out to one of the sales directors, 800 255 5055. Our creative marketing team, and creative really is the key word here, they work on a variety of different projects for a number of agents all across the country in different phases of their career. They do an excellent job when it comes to taking an idea that you have and bringing it to life. They have a very big focus on brand, and as branding has really evolved over the last few years, it's really how you look at the marketplace has placed a great importance on your digital brand. We have more and more agents who are doing virtual sales and consumers who are doing more research online. So if you don't have a robust digital brand in addition to your local market space, it can definitely have an impact on your business. If you have any questions on our creative services, reach out to one of the sales directors. At IAMS, we did launch our RAA several years ago. We've seen significant growth with our wealth management. So right now, I am going to take a moment and launch our first poll question here. And it's, would you like additional information on our wealth management? I'll take a few minutes, let that poll get out here. Next up, we have our Life and Annuity Academy. In fact, we just wrapped one of those up a little over a week ago. These events are an amazing opportunity for you to spend some time working on your business. It's not easy to do that when you're out in the field, running the business, meeting with clients, dealing with IMOs, carriers, etc. But these academies really are a great opportunity to spend some time working on your business alongside of others. So I will go ahead and launch our second poll question. We talk more about the academy here. And really at these academies, it's about being in the know with what's most current with annuities and life insurance trends, the most cutting edge marketing strategies, a wealth of knowledge on competitive products and sales ideas. We bring in top producers to present. We talk about the best practices in their business and what's created success for them. We also go over cutting edge software platforms that you might be incorporating, that you should be incorporating into your business. So, what you'll really walk away with is not only a wealth of ideas for the long term standpoint, but also ideas that you can go back and implement immediately into your practice. If you have any interest in that, feel free to check yes on here and we'll have one of our sales directors reach out to you. Lastly, make sure to follow us on Facebook and LinkedIn. We do syndicate a lot of our content, and whether it's product changes, marketing ideas, what's going on in the industry, this is one of the best ways to see that information. So with all that, I'm going to go ahead and get over to our producer on here today. We have Brian Keefe, the Regional Vice President with Symetra. Brian has been an amazing resource for us over the years, and as I mentioned, he's here with some exciting changes from Symetra. He'll also give us a deeper dive on the Connelly case and the impact that has on business owners. So with that, welcome, Brian.
Thank you, Stefan. And thank you, IAMS, for having us on. Always a pleasure when we get in front of a group of producers like this. So we're really excited about this opportunity, and hopefully we do have some value that we can add for you guys today. I'm gonna try to steer away from product. I know it's weird as a guy coming from a carrier not to talk too much product, but hopefully we can all get something out of this. And I do want to just talk about business planning for business owners, how to potentially unlock them if they're already part of your natural market. That's fantastic. These are maybe some new conversations that you can have. And if you're not necessarily working with a ton of business owners right now, how to have that conversation to maybe get them engaged and have an important discussion about how you can provide value to them. So one of the big things here is going to be the succession planning of business owners. Stefan mentioned a word that's going to come up quite frequently throughout this presentation, and that's Connelly. If you're not familiar with it, I'll give you a very brief overview. We're going to get into it later, but there was just a ruling that the Supreme Court actually ruled on, which sitting in the insurance industry, we don't have a lot of Supreme Court rulings regarding insurance products and specifically the taxation on them. When we talk about a life insurance death benefit, we always talk about the tax-free nature of it. And there was a little blip in what we've all been accustomed to, specifically relating to buy-sells. So that's something we just want to be cognizant of, and something that we hope can actually help us out with some of these business clients and getting them prepared for how to properly prepare their buy-sell agreements and passing on ownership to that next generation. So first of all, we need to identify what kind of client we're looking for here. And typically when we're talking to a buy-sell potential client, we want it to be a closely held business owner. So a closely held business owner, that business valuation is going to make up a majority of their net worth. We're not talking about a publicly traded company here. We're talking about a company where a few owners kind of hold the controlling shares of the company, and it's closely held. So it's providing them not only with a majority of their net worth, but also a majority of their income. What that means when it holds up a majority of their net worth, that likely when they have to get this business interest from where it is currently, where it's generating an income for them, they have to pass that down to the next generation, whether it's their wife, whether it's their family members, whoever that is going to, the beneficiaries here. We need to figure out how to most cost effectively, tax effectively, get this closely held business and the shares that are associated with it passed on to the beneficiaries in the most efficient way possible. So the goal here is to obviously help business owners retain their wealth. This happens by taking all the value that they've had in their business and not diminishing it, whether it's up front or whether it's on the back end when they are passing it down to their beneficiaries. We also want to retain their income. There's quite a few life insurance strategies that we can incorporate to help them retain their income, not just now, but in retirement. So if we're talking about looking for future income once they exit the business, a traditional LIRP might be a very good option. We can look at executive bonuses, so REBAs. We can look at split dollar. There's a lot of different ways that life insurance can come into helping these business owners retain their income even after they get out of the business, whether that means selling off the business and just creating a retirement income or a supplement to that income through a tax-free life insurance product. Big thing here with the succession planning of it is we want to get these business owners to pass it on to family members, key employees, or a third party. Now, this is important because these are three very different groups. If you're passing it on to a family member, a lot of times you're going to have a disinterested party that has not been involved in the business, and that your other partners in this business probably don't want making day-to-day decisions within the business. So this is going to be a really big key, getting those family members that are disinterested, the shares and the value of the business, but without having them be in the day-to-day operations. So that's going to be one big step that we're looking to kind of tackle today. The next step would be the key employees. This is somebody that's already there. So if you have just two partners in a business relationship, how to get partner A shares over to partner B when partner A wants to exit the business, keep it within there. But also at the same time, we want the beneficiaries to still get something for the value of the business, and then a third party. If we're going to have a third party sale, we need to have some value that's being transferred to get those shares of the business into the hands of the third party. There's two ways that this happens, right? You either have voluntary or you have involuntary. So the voluntary side would be the sale or gift. That's a pretty simple transaction. We have these shares. The shares are going to somebody or we're gifting them over. Involuntary is where we can step in as life insurance professionals and financial professionals and help these clients. Death, disability, divorce, these are the big involuntary things that can pass a business onto this next step. And what we want to do is help the business owner plan for this. With death, life insurance is obviously a great solution. Disability, you guys through IAMS have a great access to disability products, and with proper planning, we can take care of some of these shares and splitting up the divorce. So a lot of different options that you guys would have available to closely held business owners. Now, the action questions that we have to ask of these owners, and this is where the sales process comes in. We want to kind of help drive some of the questions that you can be asking to these closely held business owners. We want to start off by asking, do you have a time frame when you would like to transfer this business? And almost always there is going to be, yeah, I have a retirement plan. This is the plan in retirement. I want a specified person to be involved in the business. I don't want my family, or I do want my family to be involved in the business. There's just a time frame when almost all business owners have an idea of when they would like to transfer that business interest. The next step, and this is very important, are there any agreements in place that cover this transfer of ownership interest? Do you have a buy-sell? And a lot of times people will have a buy-sell, and this is where Connelly is going to come in later. This Connelly ruling has a huge impact on your lives as financial professionals because it allows you to have a new conversation. So even if somebody has a buy-sell, that in the past may have been a deterrent. You would have said, oh, they already have a buy-sell. I'm stuck here. They already have it. I can't offer them a buy-sell. But with the Connelly case, you have a great new opportunity to review their buy-sell agreement and see if it's properly structured in the new environment that we're living with in regards to buy-sells. Next question, do you have a business appraisal? And has it been done recently? So this is another big step. When we get to Connelly, we'll talk about how business valuations need to be implemented on a more annual basis, and they have to be strong. Because one of the things that the Supreme Court harped on in the Connelly case was that was not up to date, was not current, and actually was in excess of what the valuation was, leading to a big tax issue. Then we have to figure out where this business interest is going. So will the sale of the income from the business help you during retirement, and will you rely on it? And for most closely held business owners, the answer is yes. We're talking about people that a large majority of their net worth and their current income is made up of these business shares. So it would make sense that in the future when they retire, they are looking for some type of residual income from the sale of the business. In terms of active involvement, we also need to know how long a business owner is planning to be involved in the business itself. This is going to be key because if you have a partner that has a younger partner or is looking to get a younger employee involved, there's a nice conversation that can be had about key person insurance. So whether it's an overfunded design to reward and retain that key employee, keep them involved in the business, there should be some type of plan that is keeping an active party engaged and part of that day-to-day business. So if the owner that we're talking to, the business partner here, doesn't want to have any involvement, we need to set up the succession plan to get those shares over to the next generation in a potential way that that younger generation can purchase the outstanding shares from the main partner that we're representing. Then does the business have key employees? This is obviously coming right down to that core question that we were just asking. Is there a transfer of ownership that we anticipate to take place? Do you want to be involved? If there is a key employee, how can we set that key employee up for that payment of the shares to not only set up their success in taking over the business, but to set up the partner's success in exiting the business? So with life insurance products and all the products offered through IAMS, you do have some great options to not only help the partner that you're representing, but also a key employee potentially take over a business and have a successful future for themselves in the future. So instead of adding one client in the partner, if you're doing the key man coverage, you have the potential to add this new client, which would be the younger or the partner that plans to take over the daily operating of the business. So a big opportunity on some of these business cases, not just to get one new client, but to get multiple new clients and to represent a fair share of people and improve their financial future. The next question would be, are there any executive compensation agreements in place designed to specifically retain key employees? So the key man coverage that we had talked about, but there's also executive bonuses. If we're talking about a very large company or a company that has a lot of family members in it, we do offer a multi-life product where the company can fund a multi-life insurance product that will generate tax-free income for the employees on a go-forward basis. So that's a great option if we're looking at a larger group. So that would be a group of 10 plus employees. We can talk about that just at the end of the presentation. But if you do have more questions on that, reach out to anybody at IAMS or reach out to myself. But the multi-life platform is a great way to avoid underwriting, so you don't have to do 10-person underwriting. We do guaranteed issue on that, but still having access to the great index universal life products that do provide tax-free income. And then does the business have insurance coverage on the key employees? This is where the most basic of basic sales comes in. Do we have key man coverage? Is it term? Is it permanent? How do you want to structure that? But all the questions that you've asked up until this point lead to that question at the end of the day. Do you have insurance coverage on key employees to protect against their financial loss? And if they don't, this is a very easy opportunity to get in there, provide some key insurance solutions to the key employees at that closely held business. Now, from an exit standpoint, this is where we get into that buy-sell conversation. So when you had asked earlier in that line of questioning with the partner, do you have the business? Let's go ahead and value the business. You'd be shocked how many closely held business owners don't have a proper business valuation. This is something that as an agent, as a producer, as a financial professional, you can come in and immediately provide that. There's no sale involved in this. There's just you working with a team. We have resources for it. If you need a resource in business valuation, feel free to reach out to me, reach out to IAMS. We will help you guys get a professional that can properly value a business. From there, you can go two ways. You either have a buy-sell review if they do have a buy-sell in place, or you have that buy-sell creation. So now that we have a proper business valuation, we can really start making a buy-sell. So we have a value of the business. We've been talking to the partners here, so we know what the ownership stake is. Are there two partners? Is it 50-50? Is it 75-25? Are there 5 partners with 20% interest each? Now that we know what the ownership structure is and what the value is, we can put a value to each closely held share and create a buy sell from it. So we get to that conversation, and then we go for life insurance product that is most appropriate on this class. At the end of the day, the big part of what we want to do is provide estate equalization. So if a partner has 25% of the company, we want to give them their fair share in terms of passing that on to beneficiaries. If the other partner has the 75% stake, we want to make sure that they're getting 75% of the business out to their beneficiaries. We don't want it to just be a 50-50 split. So we do have some more in-depth details that go into creating that buy-sell, but everything that we've done in the fact-finding process is leading up to the creation of that buy-sell and the estate equalization. One thing that's extremely important when we are talking about buy-sells is to get a written agreement. This is one of the big factors of the Connelly case, and a lot of the buy-sells that are out there in the open market, if you are having a conversation with the business owner and they say they do have a buy-sell, is there a written agreement in place? A written agreement is going to formalize the transfer. It's going to note what triggers the transfer, and it's going to structure the transfer. More importantly, and this is the most important probably with the new Connelly ruling, is it's going to provide a valuation for the business. Without that proper evaluation, we're not going to have anything in a written agreement that says what the shares are worth and what will be passed on to the beneficiary. So what does this mean in terms of the valuation and having the written agreement? It probably means that the written agreement should be reviewed on an annual basis, just to keep that valuation up to date, and also making sure that the transfer is still going to the beneficiaries, that if circumstances change, we want to make sure the proper beneficiaries are getting past that the true value of the business that the partner would like them to receive. The types of buy-sell plans that we can do here are an entity purchase. So the entity is going to be one where the corporation owns the life insurance policies. And then cross purchase would be more of that, I don't want to call it a traditional buy-sell, but in a smaller, closely held business, partner A owns the insurance policy on partner B owns the insurance policy on partner A. So you either have it corporately owned with the entity purchase, and the business is in charge of divvying out the benefit to the beneficiaries, or the cross purchase where the other partner is in charge of giving the benefit to the beneficiaries. And then there's a wait and see. Wait and see is where you can kind of get into some trouble. This is typically without a written agreement. This is where you might have the entity owning it, want to potentially have it a cross purchase. We don't necessarily like to see the wait and sees. We would like to have the written agreement and either have it in an entity or in a cross purchase agreement. With the written agreement, we have the continuity of management there. So we are within a written contract showing who is the managing principal, who owns the shares, and it's providing a process to sell the shares that otherwise might lack marketability. Without a written agreement, you have the value of the business and you have a share percentage, but those shares don't necessarily, it's not necessarily selling. When we establish a fair and reasonable price with that valuation and we look at the ownership percentage, we have a value that can be passed on with the life insurance proceeds to the beneficiaries. It also provides control over that ownership. So if these shares were to hit the open market, if they went to the family and the family has to put them up for sale, somebody does come in and buy them, now we have a whole mess with the ownership of the posted business. So the control is a big thing with these buy-sell agreements, and one of the main factors that you can help a business overcome is that control. Control is absolutely huge. Then the two types of buy-sell structures that we had talked about, the cross purchase and then the entity purchase. I'll start with the cross purchase because it's very simple. So the owners of the business are going to enter into an agreement to buy that life insurance policy on each other's lives. So when we create that valuation, we say partner A's shares are worth $3 million, partner B's shares are worth $1 million. They're going to purchase that amount of insurance on the other partner. So each business owner is going to pay a non-deductible premium to Symetra, And then upon the death of any insured business owner, so the opposite insured, Symetra is paying the death benefit to the surviving owner as the beneficiaries of the policy, which they will then use the proceeds to buy out the deceased shares of the business and pass it on to the beneficiaries that they are intended to go to. And the cross purchase is a very clean, easy way to get those shares out, get a disinterested party from having any ownership in a closely held business. If we didn't have a buy-sell arrangement here and it was just personally held insurance instead of being cross-purchased, there's still that business valuation and shares of the business that are still on the open market. You might have outside influence coming from family members that want to be involved in the business. The cross-purchase keeps that outside interest away and goes back to that one big thing that we had talked about earlier, control. So the cross-purchase is very simple, clean transaction. Get the beneficiaries, the tax-free life insurance, keep them out of the business, get the shares into the proper ownership hands there. Then an entity purchase. So this is that corporate stock redemption. This is where the business is going to enter into an agreement and the business is actually going to be the owner of the policies. So partner A and partner B both still have the same life insurance policies, but now the business is acting as the owner. So the business is paying the premiums to Symetra. And then upon death of the business owner, Symetra is paying the death benefit to the business, which is using the proceeds to buy the deceased shares of the business. The money at the end of the day is still going to the beneficiaries, but the business is the one making this purchase instead of the other partner. And this is where Connelly really came into effect, is going after these entity owned. When we have the cross purchase, they're individually owned. Individual life insurance has always been deemed, and a lot of this is kind of a tax question. So absolutely consult with a tax attorney if you're using one for more information on this. But with the new Connelly rule, there are potential implications with specifically this entity-owned life insurance and the business passing on life insurance proceeds to the estate of the deceased partner. So what happened in the Connelly case is essentially there were two brothers that owned a business. They had come together in the beginning. They said, yep, we need a buy-sell. Brother A had 75% ownership of the company. Brother B had 25% ownership of the company. They wanted each other to get the full company upon the death of one another. So they had an entity buy-sell agreement in place where the corporation owned the policies on both brothers. They came together and they said, our business is worth $4 million. Now, the valuation on this was done at the beginning. It was not kept up to date, and there was not really an ongoing annual review of the buy-sell or the business value to see what was going on. So the day of death comes, the brother that actually passed away had the larger stake. So he had 75% of what they were going to be a $4 million company. He had a death benefit of $4 million. The business processes the life insurance claim. They try to pass on the $3 million to the estate in a tax-free manner. By doing this, they gave that 75% interest of the company over, right? So they get 75% of the shares and they buy $1 million. That's the transfer. So the state now takes only 75% of the company. Well, the IRS comes in and says, wait a second here. That $3 million that was owned by the company didn't go into the value of the shares, and it should have because it was owned by the company. So now we're in a situation where the state is receiving 75% of the shares of the business, but the business just got valued at $3 million more because the IRS is including the death benefit proceeds in the business. So now instead of 75% of a $4 million company, the value passed on to the estate is 75% of a $7 million company, or essentially a 5.7. There was a discount there. But what it did is for the estate, there was an $890,000 tax bill for an estate tax purpose that was passed on to the family. Now, when the brothers entered into this agreement, they weren't intending for there to be any estate tax consequences because they had a buy-sell and they wanted that $3 million to be passed down tax-free. That didn't necessarily happen. So one of the things that we have to really rework and review, this is the first time that buy-sells have really come under the radar. So the IRS brought this all the way up to the U.S. Court of Appeals and the Supreme Court ruled on it. So the Connelly case is something that's absolutely huge, and they found that the value of life insurance proceeds funding a redemption buy sell should be included in the value of a closely held business for estate tax purposes. So that ruling in itself is a crazy thing for us. If you've been in the business space for a while, it's just not something that's ever been necessarily on any of our radars. The easy solution here is get it out of the entity owned, right? We can do a cross purchase. That's not always feasible, but there are some things that we have to take out of this ruling. First of all, I would say there has to be a review of all entity owned buy sell agreements. If you do have a client that has a buy sell in place, go out and review it. Make sure that the way that they're valuing their business is in a way that the Connelly ruling wouldn't impact the distribution of the shares. Now, when we talk about the Connelly ruling, it sounds like we're saying all entity-owned buy-sells are bad. That's not necessarily true. One of the problems with the Connelly case was that there wasn't updates to the value of the business. So when they weren't updating the values on an annual basis and the shares weren't being adjusted, that's what caused that tax bill. So if somebody does have an entity owned buy sell and they want to keep it entity owned, that's completely fine, but you do need to make sure that they're taking a proper business valuation. They should have a written agreement and they should be adhering to that written agreement on an annual basis. They need to stick to the rules laid out in the original buy sell. Otherwise, we're looking at that potential ruling where the transfer of value passed on to the estate could potentially become estate tax taxable. And that's not something that we want to have. So the business value and the ownership stakes being reviewed annually, the buy sell, taking a look at that, making sure it's structured correctly. Do we have the correct beneficiaries? Do we have the correct ownership structure? Those are all things that you now have the ability to have a conversation with to a business owner. If you do find that there's some holes in it, can we consider a 1035 into a cross purchase agreement if there's a limited number of partners? Absolutely. Give it a look, see if there is a 1035 opportunity there. One thing that we do offer at Symetra is a really great 1035 product. We have extremely low charges. So this is the part of the presentation where I do get into our product, but Symetra itself does have an extremely low charge product. So if you're looking to do a 1035 and you find an opportunity, the Symetra product is going to be a great place to park some of these proceeds. So on an old policy, we're just using a case study here on Brad, who's a business owner, we'll say. He's a 57-year-old. He had a $1.5 million death benefit policy that he was paying $15,000 for. A lot of these, so we'll see whole life policies, maybe some GULs if there is any value in it, an old VUL that might not be performing, or even an old IUL where that's been hit with cap decreases. The Symetra policy is very good at taking over these cash values and providing high amounts of death benefit. So in this case, we take that $450,000 surrender value, we do a single lump sum of that 450 into the protection IUL product, and we're actually able to get Brad $3 million of death benefit coverage. So with the product, it's very, very strong at not only taking over the cash value and retaining it, but also increasing the death benefit in many scenarios, as long as there's no major change to the health. So for taking over that 450 and getting that $3 million death benefit, you might expect the cash value to take a huge hit, and that's not the case. Based on our charge structure, we actually still have really strong cash values in year one, and then it even grows as you move down the road in the policy. But on a $450,000 1035, we're able to keep $420,000 of value while getting essentially double the coverage for the client. In this particular case, we've also added on our built-in chronic illness advantage. So one of the things that we had talked about earlier was disability or a chronic need triggering some of these business events where an ownership transfer might take place, we actually have a built-in chronic illness rider on our protection policies. So the client would have access to 50% of their death benefit up to $500,000 as a lump sum at no additional cost. We also have an advantage rider. So our chronic care advantage rider, which is more traditional chronic illness benefit, where your client can get a 2% monthly payout up to 100% of the death benefit. So they can unlock all of that $3 million on a 2% basis. So really covering all aspects of a business owner's life here. You have the death benefit protection, now you have the living benefit protection as well if a disability on a long-term care basis were to happen. We've also added on a charitable giving benefit of 1% of that $3 million death benefit. That's available at no charge. It's one of the riders that we offer for free and is just a great thing for those charitably inclined clients. And then outside of the buy sells in the arena that we've been talking about, if the conversation does transition to a business owner wanting to provide a benefit for a key employee, we obviously have some slides on key man. We have an advanced markets team that can help you guys out structuring split dollars. We have a lot of different business resources, but we do offer a very simple multi-life program. So if you have a group size of 10 clients to 250, and we can consider larger groups, we can offer a potential GI product to get this group coverage without having to go through a full underwriting process. We do look for income to be $75,000 and above. It is an executive carve-out program. So we're looking at a minimum face amount starting at $100,000, minimum income of 75K. We do like to see white collar professions here, but it is a great benefit if a closely held business owner doesn't necessarily offer a huge compensation package, but they want to add something to it to retain these key employees. The group plan is a great way to do that. So if you have any questions on the multi-life side of the business, that's another solution that Symetra can help out with, and IAMS as well. So really some great options here. Hopefully you guys take some value and have a couple key talking points with with business owners coming out of this. The one thing I would say, take some time, look into the Connelly ruling, see if there's anybody in your book of business or in your network that you've been trying to unlock that could benefit from that conversation. There's not often times in the insurance world where we get a court to rule on one of these big things such as taxation, but it does unlock a lot of opportunities. Based on our experience, there are a ton of buy sells already in force that could potentially be impacted by this. So being able to have that conversation and see if you can provide a value is a great new, not necessarily just marketing idea, but an opportunity for your team and really everybody involved to benefit from a situation that has been brought on by the court system. At this point, Stefan, I think that's going to wrap up our side. So if you have any questions that have come out of the chat or you have anything final, we'll pass it back over to you guys.
Yeah, no questions at this time, but I will go ahead and launch our last poll question, and it's, would you like to be contracted with Symetra? I know Brian put on a great presentation, gave us some insight on Symetra. Brian, do you care about sharing more about who Symetra is and kind of what products you have to offer there?
Yeah, absolutely. So Symetra is a wholly owned subsidiary of Sumitomo Life, which is the third largest insurer in Japan. We started off, if you've been in the industry for a while, as a P&C shop, Safeco Life. So Safeco offered a little bit of life insurance, but it wasn't their focus. Safeco sold to a little investor out of Omaha, Nebraska by the name of Warren Buffett. Warren did what Warren does, held us for 9 years, made $1 billion in the sale. So we were operating as White Mountains Insurance during that time period. And since the 2010s, early 2010s, we've been operating as Symetra. So we are a new kid on the block when it comes to life insurance, but that's actually a great thing for us. First, having a Japanese partner. Japan's been living in a zero or negative interest rate environment for an extremely long time, so they see us truly as a growth engine. They've been very generous. They've given us a ton of money. They have developed some fantastic products for us. specifically on the IUL side, we offer league-leading protection IUL coverage and extremely competitive accumulation IUL coverage. So if you're looking for the LERP designs, we have you covered with the accumulation process. If you're looking for death benefit coverage, we have you with the protection IUL, and we also offer some term. One of the great things that we've kind of come into recently is our underwriting platform. So if you're looking for a simplified underwriting platform, check out our Swift line of products. We have a Swift term, and we recently just launched a SwiftProtector IUL. We can now offer coverage instantly on face amounts $1 million or $100,000 to $3 million for clients ages 20 to 60. It's a nice quick drop ticket for you as the agent. So it takes about 5 minutes to drop the ticket. Your client would get an email that takes about 15 to 20 minutes just with some personal health questions, some income verification questions, but very simple things that you would traditionally be sitting down across a table from and asking them on a part one. The client's just doing it on their own time. If everything looks good, we can offer instant coverage. We also have kind of 3 pathways on that. So you have instant coverage, accelerated coverage, and then full underwriting. So worst case scenario there, it's not just it's instant or it's a decline. If it's not instant, it does move on to the accelerated or onto that full underwriting chassis. So some great options on not just term, but also on the permanent side to get your clients coverage in a quick manner.
Thanks, Brian. I'll go ahead and close that poll session out. And do want to thank you all for joining us today. Thank you again, Brian, for jumping in on this webinar, giving us some more information on the Connelly case. If you have any additional questions, feel free to reach out to one of us sales directors here at 800-255-5055. And I thank you all once again for joining us.